Hi everyone, live from New York City. I'm Stuart Macliver, co-founder and general partner of Amvest Terraden. It's my pleasure to welcome you to today's webinar presented by Amvest Capital and Amvest Terraden. Shortly, we will be joined by my colleague Tomasz Nadrowski to discuss his new book, Mineral War: China's Quest for Weapons of Mineral Destruction. We will be diving into how geopolitics reshapes mineral supply chains and capital markets. Before we dive in, a quick disclaimer. This webinar is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security. It should not be relied upon as a basis for investment decisions. Amvest Terraden seeks to generate returns from investing in the critical mineral sector, a cornerstone of modern industry and innovation. We invest in companies involved in exploring, developing, and mining strategic minerals, the essential building blocks for modern technologies, defense applications, and modern energy systems, including transportation, power generation, and storage. Importantly, we concentrate on supply chains independent of China, helping support a more secure and transparent future for these vital materials. In 2025, Beijing made one thing clear. Critical minerals are no longer just commodities, they are instruments of strategic leverage. Through export controls and supply chain dominance, China demonstrated its ability to disrupt industrial economies and constrain US strategic ambitions. How did the world allow a single country to consolidate such overwhelming control over the materials that power advanced technologies, defense systems, and modern energy systems? My colleague at Amvest Terraden, Tomasz Nadrowski, has attempted to answer these vital questions in his new book, Mineral War. And before I introduce Thomas, I'd like to take a poll of our attendees. On the right-hand side of your screen, you'll see an option for an audience poll. If you click there, you can submit what you think is the answer to this question. How many critical minerals does China control more than 60% of the global production? We'll reveal the correct response in just a bit. We appreciate your participation and especially value questions from the audience. So please submit yours in the chat on the right side of your screen, and I'll try to ask them later in the program. Now, let me tell you a little bit about Tomasz. Tomasz Nadrowski is our portfolio manager, and he is a seasoned expert in mining investments with over 25 years of global experience. His career includes roles such as portfolio manager, commodity strategist, and commodity analyst. He has worked all over the world and is fluent in 7 languages, which makes him not only just a great travel companion, but also means he carries a knowledge base and curiosity that you need to become an expert in critical minerals. Thomas is a former director of the World Economic Forum, holds a CFA charter, and earned advanced degrees from the Geneva School of Economics and Management and the Geneva School of Social Sciences. And to this impressive list of achievements, he now adds the title of published book author. Welcome, Thomas. I want to begin by asking you why you decided to write this book and what were some of the challenges you had to overcome in doing so.
Thank you, Stuart, and thanks everyone for joining us today. To answer your question, I think we have to go back to the origins of our fund, which started a couple of years ago, focusing exclusively on critical minerals outside of China. And when we talked to potential investors, we found out that very few of them understood how these markets function, mostly because the markets are controlled by a non-transparent player, China, and mostly because many investors are afraid of geopolitics, even though this is now our daily bread and butter. The second answer to your question is an attempt in this book to create a bridge between 2 different languages, the language used in Wall Street and the language used in Washington. One relates to competitive geopolitics and markets. The other one relates to geoeconomics and national security. The 2 languages do not meet very easily, so I hope to create a basis for dialogue between those 2.
And you described this as a mineral war. When did you realize this wasn't a commodity cycle, but a structural power shift?
So the book was written throughout 2025 when the conflict between China and its trade partners started creeping into the headlines. Why war? So Karl von Clausewitz, the Prussian strategist in the early 19th century, said once that wars do not start with initial aggression. They start with the reaction to the aggression. And there is no doubt that the West is now reacting to China's attempts to monopolize and now weaponize these sectors. And that's why I decided to call it a war. We're definitely in a context of war, not a competition. The conflict and competition are just simply two different social operating systems.
In one sentence for this audience, what would it be?
Sorry, say it again.
If you had to summarize the thesis of the book in one sentence for this audience, what would it be?
I think the most important thing is that we should not assume that other people share our rationality. We in our Anglo-Saxon world that used to dominate mining across different commodities, we're definitely attuned to commercial rationality. This is what our world is good at, competition and profit making. But not all players are driven by the same type of rationality, and we should factor it in, especially today as we unfortunately celebrating the 4th anniversary of the outbreak of the war in Ukraine. The title Mineral War, China's Quest for Weapons of Minerals Destruction, because China is in the subtitle of the book, this is where we have to start. We have to start looking at China's grand strategy and how critical minerals are part of that strategy. The number one objective of the regime in power in China, the Chinese Communist Party, is to remain in power. There are essentially three instruments that are used to achieve these objectives. One is imperialistic expansion, whether in Western Pacific, in the Himalayas, or somewhere else. The second one is normalization, global normalization of that particular form of government, autocratic form. And the third one is, and that's more recent, attempts to offload economic imbalances. This third one is the one that really interests us here in this sector, the critical mineral sector. And these three instruments ultimately impact the way the commodity supply elasticity is changing and markets are being transformed. So this is probably the most important slide from which I'd like to start to put the book and the thesis there in a broader framework. And the framework is that the Chinese economic system is unsustainable. We very often agonize about levels of government or generally debt to GDP in our economies, say 130% debt to GDP in the US economy, or 230 or 240% in the Japanese economy, even though this one is now slowly ebbing away with inflation in Japan. China's overall debt to GDP is about 320 or 325% to GDP in a deflationary environment. It's extremely expensive to service that. How to unwind such an overload? So there are several ways to do it. One is, of course, rapid GDP growth. But the GDP growth in China is not as rapid as it used to be. It's no longer 10%, which could actually handle a 40% savings to GDP ratio of about $4 per $1 from the earnings invested. Right now, the savings to GDP ratio is about 47%, the growth is about 4%. So you have to actually spend $12 to earn $1. Therefore, that's not a way to unwind this overhang. The second solution is the Japanese solution. Japan famously or infamously lost 2 decades trying to move the system away from reliance on production to reliance on consumption. It's a painful, or was a painful experience for the Japanese economy. It's not sure that the political powers in Beijing have the level of legitimacy to survive such 2 decades. The third solution would be fiscal transfers, that is unwinding the 1994 fiscal reform, which saddled local governments with massive liabilities, social liabilities, health, and so on, and provided the central government with funds to pursue various strategic goals, whether diplomatic, military, outer space, and so on. It's unlikely to politically happen anytime soon. So there are only 2 solutions to unwind it. One is inflation, and one is reliance on external accounts. Let's start with inflation. China is mired in recurrent deflation. Here, the only spike of inflationary pressures were during the COVID or immediate fallout from the COVID pandemic, and that was supply-driven and not driven by the monetary policies. Why is that? Because historically, those totalitarian police states, such as PRC today, or Nazi Germany or USSR in the past, tried always to tread on the side of deflation, or at least avoiding inflation, which could galvanize local population against the regime. Some of them are very successful. Certainly Nazi Germany was, between early 30s and 1945, thanks to tools such as the MEFO bills, so Metaller Forschungsorganisation, that these were bills that were never redeemed. They just circulated and therefore didn't really feed into monetary inflation. The USSR went through a very painful currency reform after the Second World War, and they tried to remove price signals from the economy throughout about three and a half decades until the inflation actually started catching up with them in the 1980s, and that of course contributed to the collapse of the regime. An example of failure in managing inflation is Iran, which every couple of years goes through a major internal upheaval as political demands for parts of the populations are supported by the economic malaise, mostly driven by inflation and the loss of value of the local currency that I think since 1979 lost about 99%. China is mindful of that because it went through a similar experience in the late 80s, 88, 89, where inflation rose to about 20%. And we know it all ended with tanks on Tiananmen Square. Ever since, the Chinese regime has been trying to actually tread on the side of deflation and always keep the interest rates a little higher than they would otherwise could have, with one exception around the global financial crisis. This chart here shows you that over the last 33 years, for only about 18 months, the Chinese monetary policy was loose. The result of this is the falling contribution of domestic consumption to the GDP. And that fall started around 1989, 1990, so in the immediate follow of Tiananmen, and has continued ever since. Now, China decided to double down as recently as in October last year to continue relying on productive forces in line with Marxist ideology of labor theory of value, value created by the inputs, especially of economic factors, and not at the moment of exchange. During the fourth plenum, the party decided to rely on what they call modernized industrial system, and that includes not only high-end technologies, about which we think often when DeepSeek, for example, uses smuggled NVIDIA Blackwell chips in order to distill Anthropic's code through clusters somewhere in Inner Mongolia. It's not only that, it's also the mid-levels of technology, including mining, metallurgy, and chemical industries that are the sectors that are of interest for us today. So continued dominance across those different sectors rather than redevelopment of the consumer base in the country. And so since COVID, we've seen that recurrent theme of reliance on productive forces leads to a situation where actually consumption is falling off the trend, whereas production is trending above trend. This is actually in line with sort of a traditional Chinese principle of guofu, minqing, therefore the state is rich and the people are poor. Now, what does it mean for the external accounts, which are apparently a solution to this? Well, that's what we know now under the term China shock, the second China shock. Of course, the United States has been trying to rebalance the very lopsided trade relation with China since essentially 2018. And last year in 25, there was another attempt to do this, as we know, not entirely successful, but the US erected tariffs against China and other partners, and therefore much of the trade, much of the exports from China and the current account surplus has been redirected since then to other economies, with the most painful experience in Africa, which now has over $100 billion in annual current account deficit vis-a-vis China. So since China is trying to unwind its long-term over-leverage and its economic imbalances that come with over-levered supply chains, with recurrent asset bubbles, with misallocation of capital in those massive local government debts through external accounts, therefore through current account surpluses, while US, of course, tried to negotiate and maybe force China to rebalance its trade relationship on a bilateral basis, in the hope that a country that benefits from a current account surplus is more vulnerable in such a negotiation than a country that suffers from a current account deficit, in this case, the United States. But that's not what happened during the trade truce in Busan in October of last year. The truce that was clearly won by China because China was getting ready for that. And the readiness was expressed through the most important weapon, critical minerals. Now, why critical minerals are such a powerful, sharp sword? In a relation between China and Japan, we often hear about access, market access. So one of the beneficiaries of higher market access in China are soybean producers, for example, US soybean producers. But if we compare the value of the flows of soybeans from the United States to China with the value of, say, rare earths floating the other way, we find a certain incongruity here. First, China has a choice to purchase soybeans from Brazil or maybe from Argentina. Secondly, value of soybeans per bushel, about $11 at source, FOB, and about $13, including insurance, logistics, and transportation in China, is roughly the same. What is this? 20% extra premium. That's not the case of rare earths. The entire rare earth oxide business is worth globally about $6 to $7 billion right now, after a pretty significant run in prices last year. But that's not the value of the business downstream that depends on rare earths and the products generated by rare earths, especially permanent magnets. That's about over $10 trillion, 10 or $11 trillion worth of value. So if China constrains the exports of, say, $1 worth of rare earths at source, the loss for the importer is over $1,600. And that's the leverage that China has in terms of the flows of the rare earths that US doesn't have when it asks China to purchase more soybeans. And China was getting ready for this moment for many, many years. We decided to set up our fund following the first decision by China to introduce export control law in October of 2020. That law has extraterritorial application and affects potential flows of any material that the Chinese government decides is of strategic value to them. That affects a number of different critical minerals, not only rare earths, but also graphite, germanium, gallium, tungsten, antimony, and several others. On this chart, you see how many different regulatory measures have been introduced since 2020, accelerating since 2023, since the first constraint on gallium and germanium exports in the summer of 23, through many other restrictions that relate not only to the actual flow of the material, but also related technology and equipment to either extract them or process them. Importantly, when we achieved the truce with China in October of last year, for just 1 year until November of this year, conditional truce, China unwound only 4 of these 23 different measures. Only 4 of them have been unwound. The others still apply. So that's the broader context. I think if you would like to delve more into the reasons why we're there and how China managed to consolidate this power, I have to send you to the book, which is available on Amazon in Kindle and in paperback.
So I was just getting a copy of my book. So thanks for that, Thomas. And so we'll now move on to the Q&A portion of the program. Once again, we appreciate audience questions, so please submit yours in the audience chat on the right-hand side of your screen. At the start of the program, we asked you how many critical minerals does China control? More than 60% of the global production. No one thinks it's just one mineral, which is good. 10% guessed 2 to 5. No one answered 6 to 9, and 89% of you responded with over 10 minerals. The correct answer is actually 9 minerals. So with that in mind, China controls processing, not just mining. Was that a conscious long-term strategy or an opportunistic evolution? Thomas?
It's probably both, depending on the metal or material. How exactly this evolved depends first on the geological endowment in China. It's an important part of the story, but it's not the entire story. However, it's often forgotten because we don't realize that China, or southern part of China, the so-called Yangtze Craton, is geologically part of Gondwana, or was historically, and that is the southern continent that includes such ore-bearing continents as Africa, Australia, South America that we usually associate with mining of ores and metal ores. So Yangtze Craton is very rich in many of those, starting from rare earths, lithium, tungsten, tin, antimony, and several others. But that's not the whole story. The story here is the communist regimes in general obsess about metals. They obsess about metals because metals mean power. Metals mean large factories, large assembly lines, and big production, including for the defense, which is point of pride for many of these regimes. So metals have always been an obsession for Stalinist regimes, and it was not different during the Mao's experiments with backyard steel furnaces. Now, specifically in some of the critical minerals, that obsession translated very quickly into a strong midstream presence. So as soon as China managed to obtain technology from the West, all of these technologies were invented outside of China. It continued to perfect them and to build that prowess in the middle of the value chain. Well, that of course requires feedstock. Some of this feedstock was available within China, but for certain metals, cobalt, manganese, uranium, for example, about which I don't write in the book, but several of the minerals had to be sourced from overseas. And approach to overseas mining by the Chinese state-owned enterprises or state-controlled enterprises has always been very different from the Western approach, from the Western mining structure. Last part of the answer to your question is, why China and why not others? I think that has something to do with the way the mining industry and the metal industry recovered from the super cycle in the early 2000s, the first decade of the 2000s, the super cycle, which really ended around 2011 with the overheating, massive mining inflation, and the departure of commercial banks from trade financing. At that point, Western mining companies decided to focus on just very high margin and stable markets, copper, iron ore, maybe gold, without really dabbling with those marginal peripheral markets. And so China was able to develop not only this dominant position in the middle of the value chain, but also gradually creep onto dominant position in terms of mining, including mining overseas for some of those critical minerals.
Got it. And then, so we in the West have always prided ourselves on having the world's best mining companies. How is it possible that in these smaller critical mineral markets that China got ahead of us to control or sometimes even monopolize the markets?
So the monopolization didn't happen overnight. Let's say in rare earths, the West lost rare earth business much earlier than that, probably around 1980s and early 1990s, following, for example, in the United States, the decision of Nuclear Regulatory Commission to consider radionuclides, which are often associated with rare earths, as a class 7 product, all the way down to 0.05% thorium. And that excludes mining of many deposits because simply not economic to handle this product as radioactive, handle for logistics, transportation, permitting, and so on. China didn't have that problem. It started, and it's what I call Southern system, with really a Wild West, a Wild South approach with a lot of kind of cowboy-style companies, most of which have since been consolidated into state-owned enterprises. There's been a couple of waves of consolidation controlled by the state, and that sort of cowboy attitude moved across the border into Myanmar, where environmental regulations are less tight than within China proper. So there were several stages that led to the current strong kind of top-heavy structure of Chinese industry. Just in rare earth business, there are really 3 dominant companies, 2 outright controlled by the state and 1 controlled indirectly by the state, and they control most of the processing or oxide separation capacity in the middle, and much of the mining, including in one case some of the mining assets overseas. The West, as I mentioned before, didn't see these sectors as really strategic. I mean, as late as 2017, was it? Freeport sold what is one of the world's 2 largest cobalt mines in the DRC. It's only now that we're realizing how strategic these assets were, and the U.S. government and others are trying to gain some terrain But that was the attitude during globalization, and often the major mining companies looked for exit, selling off assets, and the Chinese state enterprises always were ready to pick up those pieces, including even most recently some of the nickel assets that Anglo American decided to sell in Brazil. European Union tried to actually monitor this process and was quickly pushed back by Beijing with threats of retaliation. So it's a process that took probably over a decade and a half, and the situation today is much tighter control by the Chinese state of the inflows and outflows of those materials across the Chinese border than ever before.
And we use the term critical in many different countries, and many countries have their own different definitions of critical minerals. But how do you define the criticality of minerals, Thomas?
There are essentially three levers here. One is, of course, demand, and it's often structural changes to the demand structure that matter. That means that let's say, in the technological changes we are observing right now with AI, it's quite possible that we are facing sort of a long-term quadrature curves. So something that really matters for new technologies, both civilian and military. The second issue is, of course, supply and risk to the supply. Historically, risk to the supply are concerning essentially the source, right? So is there security of tenure? Is there social peace to allow ores or concentrate to be taken out of the mining operation? Right now, as we're moving in this social operating system from competition to conflict, the chokeholds can happen anywhere over the period of transportation as the material is seeking to reach its eventual customer. We had this experience last year in one antimony shipping from Australia that was destined from North America and then transshipped through port of Ningbo in China, where it was stuck and essentially it was not transshipped and was sent back to Australia. The third area is substitution. There is a substitution risk and substitution opportunity, often with new technologies and the relative costs. But what makes critical minerals critical right now is precisely what I called conflict, because conflict depresses timelines, and the criticality is no longer based on efficiency and cost and low environmental or other negative externalities. It's about just simply availability, and not availability tomorrow, availability tonight. So it's a different form of criticality.
Yeah. And then switching to processing. So why does processing in general have such low margins relative to mining margins?
Well, that's a general characteristics of metal businesses or mining businesses in general. The value chains usually look like an inverted pipe organ in a Gothic cathedral. So high margins at source, high margins in the final product, and low margins in the middle, which means that you actually have to have a lot of volume to successfully operate as a smelter or a refiner. So that also explains how quickly we lost that capacity in the West, because once the volume starts moving away, in this case to China, it's somewhat of a floodgate, right? There's very little economic reason to maintain low volume smelting and refining if the bulk of the capacity is already left.
And so we have two questions that overlap. What is the likely timeline for the West to attain sufficient processing capabilities? And what countries can increase their share of critical mineral production, and how long will that take?
Well, for the processing capabilities, it's mostly a question of human capital. There's no denying that China is way ahead in terms of development of human capital for metallurgy of most of these materials. Numbers of engineers that count in tens of thousands. In some of the critical minerals in the West, it really counts in dozens. So that's a problem that slows down the process. We still have some institutional memory of how it was done 40 years ago, but this memory is dwindling, and so it's important to preserve it and if possible, diffuse it among different partners. In terms of the countries that are more advanced, well, definitely the three Western countries, and I use the term Western institutionally, not culturally, three Western leaning countries in East Asia, so Japan, Taiwan, and South Korea, are those that have not lost their manufacturing. Manufacturing to GDP still represents up to almost 20 to even 30%. of the GDP, and therefore they can offer services in the middle of the value chain. And the West is also sufficiently fortunate to have some eminently mining countries with significant geological potential and sufficient human capital, that is Australia and Canada. So it is possible to try and rebuild those value chains across the different allied structures.
Mm-hmm. And so then upstream, what can the West do by integrating mineral production by countries that are strong in this, like Australia, Canada, Chile, Argentina, Brazil, etc.?
So the trick here is to connect the opportunity with capital market. I don't believe, and we in our fund don't believe, that taxpayers' money can solve that issue. That should be incentivized through tax incentives for private capital. Ultimately, it's tens of trillions of dollars of equity capital in the United States, with very little of that being harnessed for the needs of this sector. Indeed, mining industry as such represents less than 1% of S&P 500, and very little of this falls into the critical mineral category. So it is important that taxpayers have an incentive to invest. I think in the case of Australia, Canada, and UK, it should be fairly straightforward, given that these three countries are part of the Defense Production Act, Title III, and therefore products of these countries and materials are considered domestic sources for the purposes of US national security. So it really requires some tweaks to the Internal Revenue Code. And I would hope that we come to this conclusion sooner rather than later to reduce the cost of capital of these companies operating in various jurisdictions, including those you mentioned.
Mm. And so why do you think capital has consistently flowed into gigafactories, semiconductor foundries, and data centers, but not into upstream supply security?
Ignorance, ignorance, and ignorance. It's always nice to imagine those pristine aseptic factories, people wearing, hazmat suits and seeing everything as a clean laboratory. Mining is not clean. Mining is not benign. And yet, without mining, there won't be any materials to feed into those gigafactories or foundries or data centers. So I think slowly the realization is arriving that we have to connect the dots in what I often describe as value chain with Swiss cheese characteristics. And it's important to fill those holes, and the holes are mostly in the middle and upstream, much less downstream.
So Ed Conway in Material World tells a story of how the UK government and its agencies appear to have an insufficient understanding of the dependencies of society and the economy on materials. Is this an ideological question where anything that reminds of the planned economy is ignored to the extent of not being aware of the weakness in the economy to material access?
Yes, probably. I would just keep in mind that there are different attitudes to economic development and growth, and some of the schools focus on productivity as endogenous element of growth, and therefore dependent on specialization, division of labor, learning by doing, economies of scale. And you can make an argument that Asian economies in general focus on that model, rather than something that's based on market dogmatism. Market cannot solve all the issues. That's why we have negative externalities and public goods. Overall, I think there is an ideological rejection of mining, certainly in the European context. We saw it a couple of years ago when the green investment flourished, at least on paper, and investment in green and sectors was promoted, and yet mining did not really qualify for the list of those technical screening criteria proposed by the European Union. If anything, I would say out of ideological reasons.
Mm. And of the minerals that are the most tightly controlled by China, what are their main choke points in each case?
So they're different depending on which one. The three most controlled are heavy rare earths, gallium, and spheronized graphite. Heavy rare earths, in this case, the answer is simple. It's all in the middle of the value chain, so separation of various oxides. There are 16 existing oxides, or 17 on your table of element, of which 15 are lanthanides. You have to separate them through several stages in a solvent extraction plant. That is a choke point that China still controls, with only 2 commercially functioning separation plants outside of China. One is in Malaysia and the other one is in Estonia. Gallium, different issue. Gallium requires a special line on the float sheet of an alumina refinery or maybe zinc electrolysis. Either solution should help us rebuild gallium supply, currently controlled 99% by China, and because alumina is sold to China, or bauxite sometimes, and then gallium is extracted, or was extracted only in the PRC. And finally, graphite. We're talking about spheronized graphite, so a specific node in the value chain of natural flake graphite that intervenes before coating, that is necessary to create precursors for anode production for high capacity lithium ion batteries. That's still largely controlled by China.
And one last question before we move to the close. What matters more today for the investor in commodities, geopolitics or the commodity cycles?
Probably both. I would say both. Let's not dismiss geopolitics. Historically, geopolitics only matter for an investor if it affected oil prices. But that's not the case anymore. Oil prices, of course, still matter, or any geopolitical event that affects that, but critical minerals are eminently geopolitical. We actually, in our fund, take this as a starting point to decide, for example, in which metal or material to invest. And the cycles are still there. And the question is, which cycles? Are we talking about inventory cycles, about investment cycles, infrastructure cycles? On those longer, Kondratiev cycles related to the technological changes. It's when we are at the cusp of some synchronized cycles on both sides is when it really makes sense to invest in those materials, and we believe we might be at the cusp of one of those cycles now.
Great, well thanks for that. I'm sure after hearing you speak so passionately today, everyone's eager to get their hands on a copy of this book. So tell us how we can do that, and if you have any closing thoughts or comments before we wrap up, Tomasz.
So the book is available on Amazon, both on Kindle and on paperback. I strongly recommend all those who are interested either just broadly in geopolitics or would like to understand how these sectors function. These sectors, using plural because there's several dozens of these materials. Also, I'd say it's probably useful for those who do some research in the area because there are rich footnotes in the book. So there are two ways to read this book: kind of a quick sort of beach reading, or something more in depth if people want to delve a little deeper into the subject.
My version's already visited the beach, so yeah, it is good beach read. So as we conclude today's webinar, I want to thank each of you for your participation and engagement. A replay will be available following the webinar, and you'll find contact information for Tomasz and me on the screen now. You can also visit our website at amvestterraden.com to learn more about our ongoing work. Thank you and goodbye.
Thank you.